This video is a review of the Accounting 1100 final exam. The final will include all material that we've covered this semester. Please make notes because you are allowed to use your notes on the exam. We're going to start by going all the way back to chapters 1 and 2, where we learned about ways that a business may form. First, remember we studied the sole proprietorship, and that is just a business owned by one person. We've done the accounting for a sole proprietorship all semester. Partnerships are businesses that are co-owned by two or more persons, and a corporation is owned by shareholders, and the corporation is separate from its owners. You'll also be expected on your final to be able to identify accounts that are assets, and we've worked with a lot of those this semester. Cash, inventory, furniture, accounts receivable, and land are all considered assets. Remember, assets are owned by a business and provide future benefit for the business. You will also need to know how an accounting transaction affects the accounting elements. So for example, we've got Mitchell Williams withdraws $5,000 from his business for personal use. How will the transaction affect the accounting equation? Remember, the accounting equation is assets equals liabilities plus owner's equity. So once we enter this transaction, we need to make sure the accounting equation is still in balance. So if he withdraws $5,000 cash, cash is an asset, so cash is decreased. The other side of that entry is the drawing account, which is a part of the owner's equity accounting element. And drawing decreases owner's equity. So we'll have a decrease in assets and a decrease in owner's equity. Next, you'll need to know the purpose of the income statement. The income statement reports the profitability of a business, or the net income or the net loss, and it summarizes the company's revenues and expenses. Next, you'll need to know that the balance sheet reports a company's assets, liabilities, and owner's equity on a specific date. Next, you'll be given a financial transaction, and you will need to determine the account to be debited and the account to be credited. Mitchell withdrew $3,000 in cash from the business to pay for his textbooks, extra class fees, and living expenses. When an owner takes an asset out of the business, the drawing account is debited and the asset account is credited. And the asset that he took out in this case was cash. So cash is decreased with a credit, and drawing is increased with a debit. In another example, we have Susan King purchasing equipment for $10,000 by making a down payment of $3,500 with a balance paid to be paid on account. So Susan received equipment valued at $10,000. So we're going to debit equipment for $10,000. She made a down payment of $3,500 in cash, so cash will be decreased by $3,500. The balance of $6,500 is owed, so we're going to credit accounts payable to increase it by $6,500. Remember, the definition of a trial balance is just a list of all general ledger accounts and their balances, and it's created to prove that debits equal credits. You'll need to know the definition of posting. When we post to the general ledger, we're posting from the journal to the general ledger. So that's the process of copying debits and credits from the journal to the ledger accounts. You're also going to have to know a few of your adjusting entries. One of those is for unpaid salaries and wages. In this example, it says wages, and we have used the term salaries in our textbook, but it's the same thing. So if for June 28th, 29th, and 30th, Mitch owes $400 unpaid wages or salaries to his employees. So that simply means we're going to add $400 to wages expense with a debit to wages expense and a credit to wages payable or salaries payable for $400. So we're going to increase the liability salaries payable with a $400 credit, and we're going to increase our salaries expense with a $400 debit. You'll need to know the adjustment for prepaid insurance. On December 1st, Mitch paid $700 for a 10-month liability insurance policy with coverage beginning on December 1st. Okay, so the first thing we need to do is find out the cost per month for that policy. So if it costs $700 and it's going to last 10 months, the cost is $70 per month. Now we need to determine the number of months that we've already used this insurance. He bought it on December 1st, but by December 31st, he had used up 1 month. If he had bought it on November 1st, he would have used November and December. If he'd bought it October 1st, it would be October, November, December. So in this case, it's just for 1 month at $70. We're going to have to show that that 70 was used up or expensed. So we'll debit insurance expense for 70 and then credit prepaid insurance for 70 to bring it down by $70. You'll need to remember how to calculate depreciation. If Mitch has motor scooters and they have an estimated useful life of 5 years or 60 months with a $200 salvage value and an original cost of $5,000, what is the straight line depreciation for the month of June? So the depreciation formula is the depreciable cost, which is the original cost minus salvage value, divided by the estimated useful life. Now we're either going to divide by 60 months if we want the amount of depreciation for 1 month, or we're going to divide by 5 years if we want it for 1 year. And here is asking just for the month of June, so we want it for just 1 month. So that would be 4,800 divided by 60 months in the useful life to give us $80 a month. You could also take 4,800 divided by 5 years and then divide it by 12 months, and you would still get the $80 per month. You'll need to know the difference between permanent accounts and temporary accounts. All accounts that would appear on the balance sheet will have their balances carried forward to the next year, so they are permanent accounts. For example, our assets like cash, accounts receivable, our fixed assets, we're not going to zero out those balances. We're going to carry those balances into the next year. The same with liabilities and the same with our capital account. These are permanent and they are not a part of the closing process. Some examples are cash, accounts receivable, accounts payable, capital, and equipment. Now, temporary accounts are those that will be closed at year end. So these are pretty much our income statement accounts and the drawing accounts. So revenues, expenses, and drawing. These are the accounts that are a part of the closing process. So you will need to remember the 4 closing entries. We use the REND mnemonic to help us remember the order of our closing entries. So the R was for revenues. The first entry is to close the revenue account to income summary. Revenue has a normal credit, so to close it, we're going to have to debit the revenue account for its balance and then credit income summary. The second entry, E, is for expenses. We're going to close expenses now to income summary. Expenses have a normal debit, so to close that account, we are going to have to credit it. And so we'll credit each expense account and debit income summary in the second entry. In the third entry, we're closing the net income that is left in income summary into the capital account. We have to remember that this balance right here before step 3 in the income summary represents the net income or either the net loss of the company. So if we have a credit balance in income summary before the third entry, then we're going to have a net income. If we've got a debit balance in income summary before this third entry, then that is a net loss. So in order to close income summary to capital with a net income, we're going to debit income summary and credit owner's capital. You know, net income increases owner's capital, and capital is increased with a credit. If we have a net loss, then we're going to debit the owner's capital and credit income summary, because net losses decrease owner's capital and capital is decreased with the debit. Then in step 4, we're going to close drawing to the owner's capital. Drawing has a normal debit, so to close it, we have to credit drawing and debit owner's capital. In Chapter 7, we learn to reconcile the bank statement. So you'll have to recall the steps in the reconciling process. To the bank statement balance, there are only 2 adjustments made. The first is for deposits in transit, which are deposits entered on our books but do not appear on the bank statement. The second adjustment will be for outstanding checks, and those are checks issued but have not cleared the bank yet. Then all other adjustments are to the book balance. For example, we're going to deduct service charges and other bank fees. We're either going to add or subtract errors, whichever way they happen to go. We're going to add any bank collections and deduct NSF checks and deduct unrecorded ATM or debit card withdrawals. In Chapter 7, we also learned how to enter cash short and over transactions in the journal. In this transaction, it says assume cash in the cash register amounts to $5.98 and sales based on the cash register tapes amounts to $600. The following entry would be prepared. All right, first thing we're going to do is enter the cash debit and then the sales revenue credit. And then we're going to fill in cash short and over with either a debit or credit, whichever makes the journal entry balance. So it's telling us that the cash was $5.98, so that's what we're going to debit cash for, $5.98. And then the cash register tape was our revenue, that's the $600. So we're going to credit sales revenue for $600. So I'd have $5.98 as a debit and $600 as a credit, which means I'm going to need $2 here to balance out the transaction. So cash short and over would get a debit of $2. Here is another example. In the cash register, we have $774, so that's entered into the debit. The cash register tape reports $769, so that is going to be the sales revenue credit. Now I have $774 as a debit and $769 as a credit. I need $5 on the credit side to place in cash shorten over to show the overage here. Make sure when you finish that your debits equal your credits. Also in Chapter 7, we established a petty cash fund. And we did that in the journal by debiting petty cash and crediting cash for the amount of the petty cash fund being set up. In Chapter 10, we learned about credit terms. On every invoice we receive or invoices that we send out, there is a section for credit terms, so you'll need to review your credit terms and make sure you remember how to read those. 210 net 30 means the buyer will receive a 2% discount off the sales price if the bill is paid within 10 days. The total amount is due within 30 days if not paid within the 10 days. 110 net 30, same as the 210 net 30, except there's only a 1% discount. 2/EOM net 60, that's a 2% discount if it's paid before the end of the month. If not, the net amount is due in 60 days. And then 310 EOM net 30 is a 3% discount if paid within 10 days after the end of the month, or the total is due in 60 days. If a bill is paid within the discount period, then we need to know how to record the payment of that bill with the discount. It says, assume an invoice from key suppliers for $575 was subject to a discount of $210 net 30. It's paid within the discount period on November the 12th. So we are going to take 2% of the invoice amount, and that will be our discount. So 2% of 575 is $11.50. So when we record the payment of this invoice, of course we're going to pay cash for $575 less the $11.50. So the net amount of that invoice is $563.50. The purchase discount is $11.50, and then we're going to offset accounts payable with the full amount, because when we recorded the purchase, we credited accounts payable at $575, so we need to debit accounts payable for the full amount of $575. Now, if the bill is not paid within the 10-day discount period, we're just going to make a payment on account where we credit cash and debit accounts payable. There would be no purchase discount. We need to know how to journalize a sale on account. So if we have merchandise costing $100 sold on account with a 5% sales tax charged, then we're going to debit accounts receivable for the total of the sales and the sales tax. So 100 times 5% is $5. So 105 will be the total the customer owes us. We're going to credit sales just for the amount of the merchandise, and then credit sales tax payable for the $5 in sales tax. Remember how to apply trade discounts. Now, trade discounts are different from the early payment discounts that we just looked at. They are a reduction from the list or the catalog price offered to usually really good customers that do a lot of business with the company. So we have an example here. Max Builders purchased lumber costing $200 with a 20% trade discount. So to enter this, we're going to debit purchases and we're going to credit accounts payable, but we're not going to enter the discount. We're going to net the trade discount out of the list price, and just record the purchase for the $160 or the net amount. So keep in mind that trade discounts do not appear anywhere on the books. They're just netted out of the purchase price. You need to know how to calculate cost of goods sold. The formula is beginning inventory plus net purchases gives us the goods available for sale. And then after we subtract out our ending inventory, we'll have the cost of goods sold. You need to know how to record purchases of inventory using the perpetual inventory method. Now remember, under the perpetual method, the inventory account itself is updated. If we're using the periodic method, that's when we use the purchases account. But when we are using the perpetual method, we update the inventory account for every purchase and every sale. In this case, we purchased merchandise on account from McFarland Distributors for $210 net 30. The cost of the merchandise is $800. So we're going to debit merchandise inventory for $800 and then credit accounts payable. You'll also need to brush up on your merchandise inventory adjusting entry under the periodic method. Andy's Auto Parts had a beginning merchandise inventory of $23,000. At the end of the accounting period, a physical inventory of the merchandise determined that the merchandise costing $27,000 was still on hand. So what we need to do is determine the old figure and the new figure, and then remove the old figure from the books and then enter the new figure on the books. So the beginning merchandise inventory was $23,000 and it has sat there on the books the entire year, so that's our old number. We went and counted our inventory and we actually have $27,000. So we need to remove the $23,000 first of all. And so we're going to credit merchandise inventory for the $23,000. That takes it off the books. And we're going to debit income summary. Then we need to put the $27,000 on the books. And to do that, we debit merchandise inventory for $27,000 and credit income summary. So it is a two-step process. The first entry removes the old figure with a credit to inventory, and then the second entry adds the new figure to merchandise inventory with a debit. Next, we're going to move into Chapter 16 with the percentage of sales method adjusting entry. So remember, in this chapter, we were trying to estimate our bad debt expense at the end of the year. So in this case, we're using the percentage of sales method, and it's exactly what it says. We're going to take a percentage of the sales and enter it into the adjusting entry. So 120,000 times 1% is 1,200. So we're estimating our bad debt expense at 1,200. So we debit bad debt expense 1,200 and credit allowance for doubtful accounts 1,200. Now we need to remember how to write off an account using the direct write-off method. So remember, when we write off an account, we are taking it out of accounts receivable. So we are going to credit accounts receivable in this case. John LaFolette's account for $500 was deemed uncollectible and was written off. So remember, written off equals being taken out of accounts receivable. So we credit accounts receivable for $500 and debit bad debt expense for $500, and that is with the direct write-off method. And then the last slide, we need to remember how to determine the due date for a note. If the term or the time of the note is in months, you simply count ahead those number of months to get to the month when the note is due. So for example, we have a 2-month note dated January 17th. So that means it's going to be due in 2 months. So February, March. So 2 months later is March 17th. So this concludes our review for the final. Make sure you prepare your notes and be ready. I wish you the best of luck, and as always, just let me know if I can be of help.